Every day, the world's top financial institutions rely on intuition know-how to deepen their expertise in both foundational and emerging subjects, from AI and sustainable finance to fintech, regulation, and core banking concepts. Search Intuition Know-how to learn more. Emerging market assets have rallied this year, with debt leading the way and equities showing signs of renewed strength. Lower inflation, easier monetary policy, and shifting trade patterns are all contributing to the momentum. Coming into 2025, emerging markets were largely shunned by investors, who were wary of escalating U.S. tariffs, continued dollar strength, and an unwavering preference for U.S. tech stocks and other perceived beneficiaries of the Trump trade, almost to the exclusion of all else. Emerging markets outperform. Yet, as the year has unfolded, emerging markets have defied expectations, delivering robust performance across various asset classes. Within the broader emerging market asset class, Chinese small caps have been stellar, with gains of around 50%, while Latin American assets have also shown. The BlackRock GF Latin American Fund is up 28.6% year to date. In fixed income, emerging market debt has comfortably outperformed developed market assets. Local currency sovereign debt has returned nearly 13% year to date, while hard currency sovereign debt has returned close to 6%, comfortably outpacing U.S. Treasuries. Easing inflation has been a key driver here, giving EM central banks flexibility to cut rates ahead of their developed market peers. Demographics and growth potential. Emerging markets benefit from younger populations and expanding workforces, supporting consumption, investment, and productivity growth. This demographic advantage contrasts sharply with aging populations in the US, Europe, and Japan, positioning emerging markets for sustained economic expansion. Structural shifts in trade and resources. Global supply chains are being reconfigured. Countries like Mexico, Vietnam, and India are benefiting from friendshoring and nearshoring trends, attracting investment as companies diversify away from China. The green transition is also driving resource demand. Chile and the Democratic Republic of Congo, for example, are seeing increased investment in copper and cobalt, essential inputs for renewable energy technologies. Institutional credibility and market depth. Over the past decades, many emerging market governments have strengthened credibility through disciplined fiscal policies, inflation targeting, and improved governance. Markets are getting deeper and more liquid, providing investors with greater access. Much of this contrasts with developed markets, where slowing growth, weak productivity, and aging workforces weigh on economic performance. Financial market participants are also concerned about high sovereign and corporate debt levels, which raise risks of fiscal drag and debt refinancing challenges. Valuations, positioning, and sentiment. Emerging market equities trade at significant discounts to developed market peers, particularly the U.S., with P/E ratios around 12 versus 22 based on 2025 estimates. This discount reflects a high cost of capital in emerging markets, which in turn stems from persistent perception gaps and underweight positioning. These headwinds are further amplified by factors such as credit rating agencies, often overstating risks, especially in Africa. Meanwhile, passive indexation, relative performance benchmarking, and short-termism have led investors to overpay for U.S. assets. Some even describe the AI boom as .com on steroids, illustrating the tendency to chase familiar growth narratives at the expense of undervalued, in this case, emerging market opportunities. U.S. dollar weakness. Arguably the most significant tailwind for emerging markets, the one that floats all boats, has been the weakening U.S. dollar. Historically, soft dollar environments have provided a backdrop for strong emerging market asset price performance. A weaker dollar boosts local currencies, attracts capital inflows into higher-yielding assets, and eases the debt burden for countries with significant dollar-denominated liabilities. This has been particularly beneficial for countries like Zambia and Ecuador. The last sustained emerging market boom, in the 2000s, coincided with a structural bear market in the dollar, which lasted until the 2008 global financial crisis. Can the rally last? Following the global financial crisis, investors were overweight emerging market assets and willing to pay a premium for their perceived growth advantage, a bet that ultimately disappointed as growth failed to meet expectations. Today, few doubt emerging market growth potential, yet assets trade at a discount relative to developed markets. Ultimately, the continuation of the rally will hinge on the dollar. Should it reverse and resume a bull market, valuation discounts and other tailwinds may not be sufficient for emerging market assets to outperform. The good news is that currency cycles tend to be long, giving emerging market advocates reason for cautious optimism. Emerging market investing is not for the faint-hearted. Grouping all emerging markets together masks stark differences, and bumps in the road are inevitable. Witness Argentina's summer turmoil or Brazil, which remains a concern for some investors given its defiance of the U.S. Yet for those willing to stomach the ride, emerging market bull markets can deliver outsized return. You've been listening to the Intuition Finance Digest. Follow us for insights into the world of finance, featuring industry voices, timely analysis, and educational content.